Hi everyone, my name is David Gully. I'm at Bentley University, and this is the second video in a series on central bank communication. So this particular video is going to be concerned with what central banks communicate and how they communicate. Please do visit us on our YouTube channel, Bentley University EC391. We have a whole series of helpful videos on various monetary policy topics. So this particular video is going to be concerned with what are the methods by which a central bank can communicate, and what kinds of things can a central bank talk about. So just have a short laundry list here. So first, central banks can have statements or release statements related to policy meetings and decisions. So for example, the Open Market Committee of the Federal Reserve, they release a statement after every meeting to tell us what they did and why they did it. It's very frequent also that policymakers will have press conferences after policy decisions. For example, the Fed in the US and the ECB have press conferences. Policymakers also very frequently give speeches on lots of different topics. Unsurprisingly, they mostly focus on monetary policy decisions, but they will also talk about the state of the economy. They'll talk about financial markets. They'll talk about risks to the economy. They'll talk about bigger picture things in terms of the overall strategies of central banks. So they cover a wide variety of topics. Central banks have a lot of material on the internet. The Fed, for example, they post minutes, transcripts, data, explanations of their policy tools, and so forth. Most central banks, to some extent, have a social media presence, mostly on YouTube, Facebook, and Twitter. Those are the most common ones. And then also, central bankers write reports and give testimony to the government. So, for example, in the US, the chair of the Fed twice a year has to testify before both House and Senate committees, and they're also required to release various types of reports as well. And so just here's a quick summary of the Fed's various modes of communication. So we have the policy statements. This is the Open Market Committee statement. The minutes that are released 3 weeks after each meeting. The press conference that is now held starting this year after each Open Market Committee meeting. The summary of economic projections. These are forecasts of future GDP and employment and so forth. These are released 4 times a year, in other words, once every quarter. Monetary policy report to the Congress. This is released 2 times per year, generally in February and July. The speeches, which of course, not surprisingly, happen throughout the year. The Fed's statement of longer run goals and policy. This is their overarching document that describes what they're doing and why they're trying to do it. And then as the Fed has normalized policy, they've been releasing updates to the policy normalization principles and plans in terms of, for example, their large-scale asset purchases. So another laundry list here. So what can they communicate? So they can communicate what's referred to as the policy framework. They can communicate their view of the current economic situation. They can communicate the forecast of the economy or forecasts or commitments to policy settings, and this is known as forward guidance. So we're going to have a whole future video on that. They can communicate risk to the economy and to the forecast, and what's referred to as their reaction function. So what we'll do here is we'll go through these one at a time. So policy framework. So central bank's policy framework is concerned with everything from the central bank's long-run policy goals or objectives to the day-to-day policy tools it's trying to use that are being applied to achieve those long-run objectives. So let's start with a central bank's long-run goals. In the US, the Fed has a fairly unique structure where it has what's referred to as a dual mandate. They have 2 main objectives. They have to maintain stable prices and maintain maximum sustainable employment. They also, just as an aside here, they have a little known third mandate of moderate long-term interest rates, but most of the action is on the employment and on the prices. So starting in 2012, they've released a document that describes what their objectives are, and this is very cleverly titled Statement on Longer Run Goals and Monetary Policy Strategy. And so what they're trying to do here is tell us what they're up to and why they're trying to do this. And so let's give an example here of why this might be really helpful. For a long time, economists and other policymakers had speculated, well, how does the Fed actually define stable prices? Because that's left somewhat vague in the Fed's dual mandate. And so the Federal Reserve Bank of San Francisco did a study very recently and they used textual analysis, and they estimated that for a long time the Fed was hitting around an inflation target of about 1.5%. Then what they discovered is that, again, using the text of speeches and statements and minutes and so forth, that they seem to be moving toward a 2% objective. But what's crucial to point out here is there was uncertainty about this because the Fed didn't actually announce what this policy objective was. So what the purpose is in clarifying this is it can help anchor inflation expectations. So in other words, if the central bank communicates to us, if the Fed tells us this is the inflation rate we're trying to hit, 2%, that helps people and firms and the public at large form expectations, and that will help achieve the actual 2% inflation objective. All right? And so in the context of the Great Recession, when the Fed started telling us about we're trying to keep inflation at 2%, remember this was 2012 and the economy was still a bit weak then, is they were concerned that inflation was too low, not too high, but too low. And so the objective was to help convince us that inflation would not fall too low, and if they're credible and the public took action, that would help maintain inflation at 2%. But even still, when the Fed first announced this, it wasn't clear what the 2% represented. Did it represent an average, in other words, around 2%, or did it represent a ceiling, in other words, a maximum? And so what they did is they changed the verbiage a little bit, and they said, well, it's symmetric, meaning we can have inflation a little above or a little below 2%. And this is in contrast with the ECB. The ECB also has a 2% inflation objective, but in their laws that govern their behavior, it's very clearly spelled out to be a ceiling. And so let's look at some language from this framework. So this is from the January 2019 version. Inflation rate over the longer run is primarily determined by monetary policy, and hence the committee has the ability to specify a longer run goal for inflation. The committee reaffirms its judgment that inflation at a rate of 2%, as measured by the annual change in the price index for personal consumption expenditures, is most consistent over the longer run with the Fed's statutory mandate. This is that dual mandate. The committee would be concerned if inflation were running persistently above or below this objective. In other words, it's not a ceiling. Communicating this symmetric inflation goal clearly to the public helps keep longer-term inflation expectations firmly anchored, as we just talked about, thereby fostering price stability. In other words, helping keep inflation anchored around 2% and moderate long-term interest rates. So they work in their actual third mandate right there very cleverly, and enhancing the committee's ability to promote maximum employment in the face of significant economic disturbances. So the point we want to get across here is that the Fed believes, hopefully rightly, that they can influence the inflation rate, but they don't, it turns out, specify an unemployment or a GDP growth goal. And the reason there is that unemployment and GDP growth, or the sustainable unemployment rate, these are kind of outside of the Fed's control. So for example, what we're talking about here would be sort of Y star in the aggregate demand aggregate supply model. In other words, the maximum sustainable level of GDP. Factors that affect Y star, population growth, technological changes, and so forth, those things are not very amenable to Fed intervention. And so they freely admit in their statement that they don't try to target this. But still, they mention this. They do talk about it. So as of June 2019, the Fed thinks the best unemployment rate the economy can do, the maximum sustainable unemployment rate, is 4.2%. Now, communicating this, though, has both upside and downside. So on the upside, once the public knows this, we can form expectations of monetary policy when the unemployment rate is above or below. So for example, if the actual unemployment rate is 7%, and the Fed says the best estimate of our sustainable unemployment rate is 4.2, we would expect them to pursue an expansionary policy. And so we can form our expectations accordingly. But on the downside, suppose the Fed is wrong about this estimate. Suppose that the actual natural rate is lower than 4.2%. Well, what they might do is tighten too soon. As the economy approaches 4.2%, they mistakenly say, gosh, this is the best we can do, and they pursue a tighter policy. It works the reverse too. If the actual unemployment rate, whoops, should have a little if here. the unemployment rate is higher than 4.2%, then they risk tightening policy too late. In other words, the economy moves below that sustainable rate. So there's risks on both sides here. Now, aside from the longer run objectives, policy framework also involves a lot of nitty-gritty. So what we want to talk about here are policy tools. These are what the Fed or any central bank really uses on a day-to-day basis to achieve its objectives. So right now the Fed has 3 current policy tools. They're open market operations, and we have a whole series of videos on our YouTube channel. IOR, that's interest on reserves, and the ONRP. ONRP is overnight reverse repurchase agreement. We also have some videos explaining that. And then also their third tool is communication, and that's of course this particular series of videos. Now, these day-to-day policy tools are used to help the Fed achieve its longer run objectives. So, for example, back when the Fed was buying lots of treasuries and mortgage-backed securities with their large-scale asset purchase programs, they communicated the reasons for doing this, they communicated the volume they were buying, they communicated how long these purchases were going to last, they communicated that under the circumstances under which they would last, and so forth. In another example, the interest on reserve and the ONRP rates, these two rates are used to control or to influence the federal funds rate. And the federal funds rate, it turns out, is an example of what's called an operating target. And so what it will do, the Fed will communicate that it's changing its target rates for the IOR and the ONRP and explain why they're doing it. And right now, again, just for the sake of clarity here, the Fed's main operating target, the one they're most focused on average, is the federal funds rate. Now, under normal circumstances, in other words, way back in the day before 2008, in order to influence the Fed funds rate, the Fed used standard open market operations, in other words, the buying and the selling of U.S. Treasury securities. Since they've expanded their balance sheet after the 2008 recession with large-scale asset purchases, in other words, QE, they now use, and will be using for the foreseeable future, interest on reserves and the ONRP rate to influence the federal funds rate. And a little interesting aside here is they had a debate as to whether they should ditch the federal funds rate as their operating target and move to the IOR, ONRP rates, or to keep the federal funds rate. And so what they ended up doing is, after some debate, they ended up keeping it. Now, in turn, operating targets, like the federal funds rate, are used to influence what are referred to as intermediate targets. And so, as the example here, the Fed uses the federal funds rate to influence longer-term interest rates, like the 10-year Treasury rate, like, for example, mortgage rates and so forth. These longer-term interest rates will, in turn, and this is the important part, will tend to influence its policy goals of inflation and GDP growth. And what we'll see in the next video in this series, they use communication, forward guidance, to influence longer-term interest rates more directly. Now, in terms of its policy framework, a central bank communicates information for a whole bunch of reasons. So first, and most importantly, it tries to influence its long-run policy goals. So that's its major objective. They also try to provide as much clarity as they can in terms of how they're attempting to achieve this. And the reason they are trying to provide this clarity is to try to minimize uncertainty. Because to the extent that a central bank can minimize or at least reduce uncertainty about what it's doing and why it's doing it, that'll help reduce volatility in inflation, GDP growth, and also reduce volatility in financial markets. And then finally, they have a variety of legal requirements in terms of reports and testimony and so forth that they might have to communicate to lawmakers. Central banks also communicate their view of the current economic situation, right? And so the idea here is they talk about the current economic situation, and what they always try to do is try to put the current situation in a framework or relative to what their objectives are. So they're trying to tell us this is how we see the economic situation relative to what our objectives are. Now, in the US, the most single authoritative communication the Fed makes in this situation, or in this sense, is the statement that they release after each and every open market committee meeting. Also, once the statements are made, generally, is after that, open market committee participants go out and give speeches, and they talk about how they see the situation personally. If you ever have a chance to read the minutes of the open market committee meetings, and they're very gripping reading, by the way, is they have extremely detailed discussions of lots and lots of economic variables in terms of financial markets, in terms of the real economy, international considerations, and so forth. And then they also have two really very important policy reports. One they've been releasing for a number of years, the Monetary Policy Report, and then a relatively new one, the Financial Stability Report. So these are gold mines of information about the data and the context in which the Fed analyzes and sees and understands the economy. So let's do a specific example. So this is some of the statement from the Open Market Committee's May 2019 meeting. So information received since the committee met last in March indicates that the labor market remains strong. Let's emphasize these. Economic activity rose at a solid rate. Job gains have been solid on average in recent months, and unemployment has remained low. Growth of household spending and business fixed investment slowed in the first quarter on a 12-month basis. Overall inflation and inflation for items other than food or energy, in other words, core inflation, have declined and are running below 2%. In other words, they're below the Fed's objective here. And then on balance, market-based measures of inflation compensation have remained low in recent months. So they're low here. And survey-based measures of longer-term inflation expectations are little changed. And so we want to sort of maybe translate this a little bit here. So what are they telling us? Well, their objective here is to communicate how they see things relative to what their goals are. So specifically, they describe the labor markets as strong and economic activity as solid. So in Fed verbiage, these are really good descriptions. And so these descriptions possibly suggest that at some point, possibly a need for tighter policy, and certainly, at least right now, no need for looser policy. But also in that very same statement, they said that inflation is running below their objective. Well, that part of the statement might call for other things equal looser policy. And so the idea here is that sometimes it's a bit difficult to understand or to imply what a central bank might do. And the reason it's difficult to know is that the central bank sometimes itself just isn't sure because the situation isn't perfectly clear. Central banks also make forecasts of the overall economy and also of their own policy settings. So not only do they talk about, well, here are things now, they also talk about, well, here's how we see things evolving. And so when you look at the minutes of the Open Market Committee's meeting, speeches given by Fed officials, these folks are always talking about how they see the economy evolving. They also publish, and this is what we'll talk about here in a second, so it's referred to as the Summary of Economic Projections, the SEP. So what they do here is they provide specific forecasts of the individual members of the Open Market Committee on inflation, GDP growth, unemployment, and the federal funds rate over the next few years. Now, what's important to keep in mind here is that all forecasts, all economic forecasts, are always based on assumptions. The SEP forecasts are based on assumptions about how monetary policy is expected to behave and how external factors aside from monetary policy are expected to behave. So in other words, there's lots of factors outside of the Fed's control, and they form expectations about how these things might work. And then they also, and this is critical here, they also assume that they don't make themselves any policy mistakes. In other words, they get policy right, and if we get policy right, this is how we see GDP, inflation, etc., evolving over time. So here's an SEP from this is the most recent one from June 2019. And so we'll just look at the first group of data here. So this is the median, in other words, the central tendency. So they look at the predicted path of real GDP growth, predicted unemployment rate, predicted overall inflation rate, predicted core inflation, in other words, excluding food and energy. And then they also individually give projections of what the federal funds rate is. And so what they do here is they ask all the participants, all the members of the Board of Governors, all the bank presidents, how do they see these different variables evolving over time, 2019, 2021, and in the longer term. And so then they take the median of this. So what I want to emphasize here is that these are not forecasts of the committee. These are the medians of the individual forecasts of the people who participate in the decision-making process. So it doesn't represent an aggregate committee forecast. And so you can see, for example, that in the long run, they, on average, expect GDP to grow at a little below 2%. Unsurprisingly, they forecast that they're going to get inflation correct. And then finally here, again, these represent the median values of the path of the federal funds rate. And so in the long run, they think the federal funds rate, again, on the median, will be around 2.5%. And then the other columns here, they give the central tendencies, and then they give the ranges. Now, if you look at the longer run values, so if we go to the previous here, so these longer run values, these represent sort of the Fed's goals. So they expect, in other words, that GDP, the best sustainable growth, 1.9% per year. The best sustainable rate of unemployment, in other words, the natural rate of unemployment, they estimate at 4.2%. And then, unsurprisingly, they expect to hit their inflation objective of 2%. Now, what you want to keep in mind, though, is this. When you read these SEPs, it's highly unlikely that the Fed is ever going to forecast a recession. Why is that? Well, key thing to keep in mind is that these forecasts assume the Fed does the right thing with policy. And if they do the right thing with policy, that makes it, of course, less likely that there actually was a recession. Now, there could be, but it makes it less likely. The other thing, sort of the practical thing, is if they forecast a recession in the SEP, that can undermine confidence. In other words, that could damage the Fed's credibility. So an open question that we're not going to address here is, well, does that reduce confidence in the accuracy of these forecasts? And what I want to emphasize again is that these don't represent the committee's aggregate forecasts. They represent the summaries of the individual forecasts of the participants. But even still, the Fed's forecast can be actually pretty good. 2019, the San Francisco Feds did a study, and they looked at the Fed's forecast relative to those of private forecasters, and over longer periods of time, the Fed seemed to do a consistently better job. Now, central banks also in recent years, and they've really moved in this direction very heavily, they've discussed forecasts of their policy settings, like, for example, the federal funds rate that we just talked about. These are also, and this is critical to note, these are all conditional on particular assumptions, like, for example, the Fed assuming it doesn't make policy mistakes. So sometimes these, in fact, are just forecasts. But sometimes they move beyond being just forecasts, and they turn out to be commitments to a policy path. And generally they're for an interest rate, but they could be for other things, but it's usually for an interest rate. When a central bank does something like this, when it says, this is what we are going to do with our future policy settings, this is what's called forward guidance. Now, we've got a whole video on forward guidance. That's going to be the next video I'm going to record here. But what we want to do here, though, is a short summary, just as a kind of to introduce it. So first, we need to define what do we mean by forward guidance. So we take this from the ECB. If a central bank gives forward guidance, it means it's providing information about its future policy intentions. So here's the key thing. Forward guidance isn't just a forecast. It isn't just a prediction. It's a commitment. This is what we're going to do with policy. Now, generally, forward guidance is used in conjunction with a central bank's short-term policy rates. It doesn't need to be, but generally it is. So when a central bank uses forward guidance, what are they trying to do? Well, the first thing they're probably trying to do is they're trying to provide confidence. The bottom line is this: if an economy is weak, if aggregate demand is low, like, for example, it was in the Great Recession, they're trying to tell us that they're on the job, they're committed, and we're going to, for as long as necessary, pursue an expansionary policy until the economy is better. This confidence, if that increases business confidence and consumer confidence, this can work to increase aggregate demand and move the economy back toward full employment. Secondly, this is slightly more detailed, if they tell the public that they're going to keep their short-term policy interest rate relatively low for a while, that will help in turn bring down longer-term interest rates. So in other words, if they tell us that their operating target is going to be at a low level for a while, that'll keep their longer-term intermediate target also low as well. So why is this the case? Well, it turns out that long-term interest rates can be shown to be an average of short-term interest rates plus what's called a term premium. Now, the details of this are beyond the scope of what I want to cover in this video. We do have a video on the yield curve that explains the link between long rates and short rates. The bottom line is that long-term interest rates can be shown to be an average of short-term interest rates. So let's do two specific examples of forward guidance. So as late as 2012, the Fed was committing to keep the federal funds rate low for roughly 3 years. And so note the verbiage here, to support continued progress toward maximum sustainable employment. So they're trying to get us toward long-run aggregate supply. The committee expects that a highly accommodative stance of policy will remain appropriate for a considerable time after the economic recovery strengthens. In particular, the committee decided today to keep the target range for the federal funds rate at 0 to 1/4, so this is when they're at the zero lower bound, and currently anticipates that exceptionally low levels for the federal funds rate are likely to be warranted at least through mid-2015. So they're telling us the interest rates, that short rates are going to be low for a while. That helps keep longer-term interest rates low. That should work to increase aggregate demand. And they're also, again, trying to instill confidence as well. The Fed and other central banks, for that matter, they've used forward guidance also for their large-scale asset programs, in other words, their QE programs. So aside from actually just buying Treasury securities and buying mortgage-backed securities, they communicated the time horizon of the purchase, in other words, how long they would go, the total volume, and also the rate of asset purchases as well, and then maybe most importantly, under what conditions the rate of purchases would change or not change. So let's give an example here. So this is from September of 2013. Committee will closely monitor incoming information on economic and financial developments in coming months. If the outlook for the labor market does not improve substantially, the committee will continue its purchases of agency mortgage-backed securities, in other words, MBSs, undertake additional asset purchases, and employ other policy tools as appropriate until such improvement is achieved in the context of price stability. So they're telling us we will keep pursuing our QE programs as long as things aren't that great. So you can count on us to do this. So again, they're trying to provide this confidence. So the central bank also, aside from actually making the forecasts and communicating these forecasts, they communicate the risks as well. And it turns out, again, like we've already emphasized, all forecasts have certain assumptions. Now, one of the assumptions, obviously, is the Fed doesn't make itself any policy blunders. But they also recognize that they've got factors outside of their control. And so then based on these assumptions and then the statistical models, and some of these statistical models can be pretty fancy, they create these forecasts, and these can be found, for example, in the summary of economic projections. But central banks, remember, they have a lot of things that are outside of their own control. And so let's do a couple of examples here as of mid-2019. So right now at the moment we have trade tensions between the US, China, Europe, and actually even other countries as well. So for example, the US and China have imposed tariffs on each other's exports. The open question is, well, what kind of impact will this have on GDP and inflation? Will these tariffs be removed? Will they be expanded? How long will they carry on, etc.? And what kind of impact will this have on the overall economy of not just the US, but of the world? There's a lot of uncertainty there. Also, what's going on right now, we have Brexit. When will the UK exit the EU? Will it exit the EU? If it does, under what circumstances will the exit happen? What will the impact on the UK economy be? What will be the impact on the EU economy, and how will that blow back to the US? So right now, there's a lot of uncertainty on these two dimensions. There's other things going on, but we just want to focus on these. Now, what's important here is that these situations could work out either really well, or they could work out really badly, or of course, anywhere in between. Depending on how well they work out or how well they don't work out, US GDP growth, inflation, etc., could be impacted. And so central banks have to stand ready to deal with these. And so what they try to do is they try to communicate to the public that we are aware of these situations, we're monitoring them, and we're considering what would happen under different scenarios if, for example, Brexit and the trade talks work out well versus if Brexit and the trade talks don't work out so well. And then the final topic we want to talk about here is a central bank's reaction function. So here's what a reaction function is conceptually. So it describes the data and how it responds to the data. So the idea is if a central bank looks at, say, for example, inflation, if inflation is too high, a central bank's reaction function will tell us, well, if it's 3 percentage points too high, this is what we'll do with policy. If it's 2 percentage points too low, this is what we'll do in policy on the other hand. Now, it would be really very helpful if a central bank would actually publish an equation or maybe several equations that would tell us what their reaction function was, but they don't do that. Even still, though, reaction functions are really helpful concepts to think about to try to understand how central banks think about making policy. So if you look at the Fed's website and try to hunt around to see what their reaction function is, they don't actually publish it, but what they do publish is a very helpful description of how they think about things. So in setting policy, the committee seeks to mitigate deviations of inflation from its longer run goals and deviations of employment from the committee's assessments of its maximum level. These objectives are generally complementary. However, under circumstances in which the committee judges that the objectives are not, it follows a balanced approach in promoting them, taking into account the magnitude of the deviations and the potentially different time horizons over which employment inflations are projected to return to levels judged consistent with its mandate. It turns out this is a really helpful verbalization of the whole concept on which the Taylor rule is based. Now, we have a whole video on the Taylor rule, so I'm just going to give a little short introduction here. The idea is that a Taylor rule tries to help conceptualize how a central bank thinks about setting its target short-term interest rate. So in the US, the target short-term interest rate is the federal funds rate, and that's a function of the underlying real interest rate, the actual inflation rate, the weights on which it places deviations of inflation from its target, and GDP from its target. So actual little pi here, that's the actual inflation rate. Pi star, that's the central bank's target inflation rate. GDP is the actual GDP growth rate, and GDP star is the target GDP growth rate. The idea being is if inflation is above target, what that should say is we should see a higher federal funds rate. In other words, a more contractionary policy to reduce the inflation rate. Other things equal, if GDP growth is below target, we should see a lower federal funds rate in order to move GDP growth back up toward its target. And so again, the idea here is that the Fed's funds rate is set according to deviations of inflation and or GDP and employment from their objectives. So I've operationalized this version of the Taylor rule with GDP. We could also operationalize it with, for example, the actual unemployment rate relative to the maximum sustainable unemployment rate. It doesn't change the outcome, but I thought I would go with this operationally. So here's the key point I want to make here is the Fed, use the Taylor rule to set the federal funds rate, but what they do is they do have a number of variations of the federal funds rate or the Taylor rule to help them provide what might be thought of as a baseline to think about what the right federal funds rate might be. All right, so they don't have an actual reaction function, but there are certain types of data that we know that particular central banks pay a lot of attention to. So for example, we know that the Fed pays lots of attention to the unemployment rate, the inflation rate as measured by the Personal Consumption Expenditure Price Index, and this is both the overall inflation rate and the core index. The core index excludes food and energy, and then also real GDP growth. So those seem to be the main ones. They certainly also pay attention to lots of other things. For example, in the labor market, they pay attention to wage growth and the labor force participation rate. In terms of other policy things, they pay attention to what's happening with fiscal policy in terms of government spending, in terms of tax changes as an example. Now, very recently, starting in 2018, the Fed started releasing another exceptionally helpful report called the Financial Stability Report. And what this does is this gives a great detail of looking at what financial variables the Fed pays a lot of attention to. Because we've always known that the Fed pays attention to the financial markets, but they've never given us a lot of detail. Now they have. They've given us a framework. So the four classifications of data they look at are asset valuations, meaning, for example, equity prices and, say, real estate prices. They look at borrowing by households and businesses, particularly, for example, with households, they might be looking at the student debt outstanding. They may be looking at mortgage debt outstanding. They also look at financial sector leverage. They look at, for example, at debt to equity ratios, how leveraged are companies in the financial sector. And then they look at what's called funding risk. Funding risk is the risk that financial companies cannot roll over or refinance the liabilities on the right side of their balance sheet. And so now that we know the most important data the Fed looks at when evaluating financial markets, is we, the public, can look at the same data to try to think about, well, okay, given the data that we're looking at, how might the Fed interpret the information from, say, elevated equity prices or elevated real estate prices or lots of leverage in the financial sector? Again, we don't have a specific equation that tells us, but at least we have the same data that the central bank is providing us. So in summary, in the last several decades, central banks have dramatically ramped up the volume of their communication. The main reason they are communicating is their goal is to help them achieve their own objectives. In the Fed's case, it's the dual mandate of stable prices and maximum sustainable employment. They have a very wide variety and an ever-expanding variety of communication methods that they use. And then they communicate all aspects of their policy, from their overall framework to the forecast of the economy to the types of data that they monitor. Thank you.